I've been using put and call warrants a little more over the past few weeks, and now that I've experienced how volatility can help or hurt, I wanted to share a primer and some random thoughts on what I've learned. Global stock markets are now around 20% lower than a few months ago, and that puts them into bear market territory. That's a term that's often used to describe a market that's fallen 20% or more from the recent highs. So just to start with, I wanted to give some background points on warrants, and it is incomplete. There's a lot more learning to be done. Number 1. Around 250 underlying assets, that's a company, a currency or an index, have tradable stock warrants based on them. Hong Kong listed companies make up the bulk of this, and stock indices, commodities and currency pairs, they make up the rest. In total, around 10% of all Hong Kong listed companies have tradable warrants. And it's important to know that these warrants are issued by investment banks and not by the companies themselves. So unlike stocks, these warrants don't give you any ownership rights. Number 2. Warrants can have massive inherent leverage, and that's also called gearing. And they will rise much more and fall much more than stocks, and so you generally don't need to deploy as much money to enjoy a similar exposure. But it's also vital to know that leverage works both ways. So warrants can gain or lose a lot of value within days or even hours, and they are used for speculation and not for long-term holding. Number 3. It can be a lot cheaper to use warrants for short-term trading, so if you're a swing trader or a day trader, this might make sense for you. Warrants in Hong Kong, for example, they're exempt from 0.1% stamp duty that's applied to stocks, and while that might not sound like a lot in savings, if you're out on brokerage commission, that saving can be 0.3% or more. Number 4. Warrants have maturity dates which can be just days or weeks or months away, and when they mature or expire, they can be worth something, or they can be worth absolutely nothing. So be aware of the maturity date, and the value of the warrant can fall close to zero long before its maturity date, and that's the case usually when the warrant is way out of the money. Number 5. Warrants trade on the Hong Kong Stock Exchange just like a stock, so usually under a 5-digit ticker or code. A regular stock brokerage account will allow you to trade warrants, even though warrants are highly speculative. And this to me puts them slightly at odds with the investment knowledge and experience questionnaire that you're asked to complete when you open a trading account. Because if you're able to access stocks, you can also access warrants, even though the two are very different. And if you contrast warrants with options and futures, which are also speculative, it can be hard to understand why there's a differentiation. And one reason could be because the loss in warrants is limited to the size of your investment, while it's potentially unlimited for futures and options. It's the responsibility of the individual to know exactly what they get themselves into. Number 6. Investment banks like JP Morgan, HSBC, SocGen, Goldman Sachs, they issue warrants and they act as market makers after warrants begin trading. Market makers are very important to you in providing liquidity because they're pretty much the only people who are going to be there on a daily basis to sell to you and buy from you. Market makers usually sit on both the bid and the ask side with a large number of warrants to buy from and to sell to you. But they're not always there when you need them. And on one particularly volatile day last week, the market maker on a warrant that I held, they didn't show up until about 2 hours after the market opened. So with no other bids on the screen, I couldn't really do much until the market makers arrived. Number 7. Some market makers are fairer than others. The big ones are not necessarily the best, but over time you'll get a feel for which ones you like to trade with and which ones you don't. Usually it's because they're either not there when you need them or because the bid-offer spreads are exceptionally wide. Number 8. Even with larger and more established market makers, it's important to note that they don't always make markets or provide liquidity in all of the issued warrants, at least not on the screen. Many warrants regularly have no daily traded volume. Number 9. It's better not to leave good till cancelled or GTC orders on warrants. Unlike stocks, the value of a warrant depends on several factors, including the volatility of the underlying asset. If you leave an order to sell based on yesterday's gearing ratio, you could be buying or selling at unfair or less fair prices. Gearing and price can change significantly if the volatility of the underlying stock jumps. So as an example, I had a call warrant with an effective gearing ratio of 8 times, and I was happy to sell based on the underlying rising 2% or so. And that means the warrant can rise roughly 16%. That's 8 times gearing times the 2% rise. And so I left the GTC order at the equivalent price. The next day the stock gapped up 2% on the open, and the warrant maker actually made a market that was 25% higher. Volatility has shot up, and that added further upside. So instead of rising around 15-16%, the warrant rose 25%. Now, experienced and astute warrant traders had of course seen my cheap offer, and they happily took me out. So the lesson really is to wait for the market to open or to use a warrants calculator to work out a simulated fair value. Number 10. It's best not to leave market sell orders or buy orders. Market orders are where you buy or sell at whatever is on the current offer or bid. Warrants are generally less liquid than stocks, and market makers might not be there at the open. But there will be people who opportunistically place offers and bids at prices that are far above and below the last traded or fair price. So if you leave a market order, you could end up lifting or hitting these levels and sell or buy at absurd prices. Number 11. Even if you see a large bid or offer at the price that you want to trade at, it's better to set a limit price and not place a market order, because those bid offers can disappear for a few seconds as market makers change their prices. And so if you place your order at exactly the wrong time, you might get filled at nonsensical prices. Or at least not at the price that you intended to fill at. Number 12. Warrants have decay value, which means that they naturally lose value every day as they get closer to maturity. However, it can also feel random when prices get marked up or down during the day. Warrants price over the day can move up or down significantly without the underlying asset's value even changing. And this, I believe, is mostly related to volatility. The value of a warrant can be marked down as volatility falls, and volatility will fall when the underlying asset becomes less choppy. I've experienced both ends of this. I had a call warrant that was marked down roughly one spread every half hour or so, even as the underlying stock remained unchanged. So by the end of the day, the warrant had lost about 10% of its value, and the stock was unchanged. This can feel like a very strange and frustrating experience. Number 13. Maybe the most interesting thing that I've experienced in this past week is that with markets falling significantly, a call warrant can rise in value even as its underlying stock falls sharply. A call warrant will generally lose value as its underlying asset declines, but if this decline happens in a sharp gap move, like when a stock drops at the opening of the market, the gap can actually cause the value of the call warrant to rise and not fall. So from experience, I had one call warrant on a stock that gapped 10% lower, but the warrants opened unchanged when they began trading. Higher volatility or implied volatility had added quite a lot of value to the warrant. On the flip side though, as you've just heard, decline in volatility can also take a lot of value away. I hope my experience helps you a little bit in understanding about volatility and how it affects calls and puts in a very volatile market.